idiot reported it as fraud and I got shut down and I had to appeal. So here I am going live on YouTube now. I haven't been live on YouTube in a while. I wanted to take a little time, even though, listen, the lighting isn't great, whatever, but wanted to take some time and go through and create some content showing people how to utilize whole life insurance with real estate to create financial freedom. Now, I'm gonna just go through this and let's do it. Let me see if everything is looking okay here. So, all right. So one of the things that we're gonna do. Let me see how I'm gonna do this here. Why don't I have? It's weird. Hey, what's going on, y'all? So for some reason, it doesn't give me my little laser thing on this in this option. I gotta, I guess, give it another update. But so one of the things I'm doing here is I'm going through. I'll flip the camera for a second. I'm going through and I'm talking about utilizing whole life insurance. I've got my vibe board here. I'm sitting at a rental property, but I went to storage and I got my vibe board out of the storage because I'm back in Arizona. What's going on? What's up, Kenneth? What's going on, man? So I'm at this this rental and I just got the vibe board out and I wanted to take some time to go through and just kind of share my vibe board and go through some of the numbers here and talk about how to utilize whole life insurance as a foundational asset, explain away, to people how life insurance policies work and how you can utilize them to create wealth by leveraging the cash value for real estate. So you could see here that I have an individual that, and this is a real case that we're working on, something that we put together for a real estate investor, and I just kind of changed their information on here to make it, privacy protected, so on and so forth. But it's $200,000 year one. You could see $24,000 a year after that moving forward. We got a 7-year term rider, so you can see that's why the premium drops a little bit. The term rider drops off after that, right? And then on this 200,000, that means we had 176,000 because we got 200,000 minus the $24,000 annual premium, and that leads to the $200,000 total, right? So $176,000 is the front load that we would call in this policy, right? Now, when we look through this, $200,000 going in year one. I want to show you guys how powerful and how efficient these policies can be, because out of that $200,000, you could see here, we got $187,000 in net cash value, right? And when you look at that, we're picking up $2,959,000. Now, here's the thing. And by the way, anybody has any questions, any comments, feel free to get in there, comment, chat. Let me know if you have any questions. I'm happy to engage, answer anything that you have going forward as I'm talking about this. So the beautiful part about this, there's a couple things that I want to show. Year two, you're putting in 24,000, right there. But here's the deal: the policy is growing by 28,000, right there. Okay. Now, the other metric that I want you to look at, and what makes these policies really amazing, is that by year four, you can see year four, we go across $272,000 in cumulative premium. Okay, $274,000 in cumulative premium, and we got $278,000 in net cash value. So when we talk about how to design a policy properly, I don't believe there's any one right or wrong way to do a policy. I think it's important to understand that it's always a give and a take. It's always a blend of what's right in the short term. What are your liquidity needs in the short term and your goals? How are you planning on utilizing the cash value? When it comes to looking at this number right there, it's important to understand that you want to be utilizing that to buy cash flow producing assets. We're not utilizing that for lifestyle expenses. We're not using that for anything else. This number is designed to be there to increase your financial efficiency, right? That can improve your investments. That can improve the way that you are buying major capital purchases for businesses or cars or anything like that. The bottom line is making sure that you leverage this to increase what you have going on financially, the efficiency in your life, okay? So now there's a couple things that we're doing here. We got 3 million dropping down to 976,000. You could see right there, right? because what happened was is we have a 7-year term rider right there, and you can see the death benefit or the premium drops from 24 to 825. So that means that the term rider was $1,175 per year, right? Which is a pretty good price considering you got about $3 million of extra insurance coverage, right? So that's where we use the term rider, right? So that's what we're doing there. Now it drops off from that point on. Think about it this way. Remember, one of the things I always tell people is that life insurance, when we talk about doing these policies, the thing that Primerica agents don't understand, Dave Ramsey doesn't understand, you cannot compare whole life insurance to an investment because it doesn't have the same risk profile as an investment. This is a savings alternative. So when I look at this and I say, okay, hey, look at this. I've put in at the 7-year mark, I've put in $344,000. I've got $388,000 of cash value. And then from there on, the term drops down. But still, even though that term drops down, they're gonna I got 429,000 after contributing only 366. That's pretty darn good, y'all. Right? That's really good, in fact. Right? I'll answer that, Kenneth, in a second. So that's pretty awesome though, because now what we have is we have the 429, and plus we have the death benefit. It's about $550,000 death benefit above and beyond that 429, right? And so a lot of people are saying, hey, why would the insurance company keep the cash value and or why would I want to do this if the insurance company keeps the cash value and they only pay you the death benefit? Well, the answer is the death benefit was lower. It was lower than the 976 when you first started, right? So let me go here and I'll show you kind of exactly what I'm talking about. So 187 right there, okay? And you could see you got $2,959,000. Well, 187 grows to 215. That's about a $28,000 increase, right? So that goes up by 20,000. But look what the death benefit grows by. 259 to 305. That's about a 46,000. So you got a 28,000 increase in cash value, but a $46,000 in death benefit. So you're actually coming out ahead. So that as the cash value increases, the death benefit goes up with it when we're utilizing. The full thing here is, even though that's the case, even though they are keeping the cash value and they're paying you the death benefit, the bottom line is this death benefit is increasing as the policy goes on. Now they could separate this and keep the death benefit more level, right? And have the cash value be completely compartmentalized, but they'd have to tax this completely differently on the inheritance, right? So by doing it the way they do, you get this full 976 tax-free versus having a smaller death benefit tax-free and maybe paying taxes on the cash value. So hopefully that makes sense, right? Is it a bad idea to get a loan the first year? So the hard part is you can't illustrate a loan the first year. So the answer is no, it's not a bad thing to do. It's not a bad thing if you wanted to get a loan out of this 187. Problem is you can't illustrate. Like I can't show a loan coming out year one, even though you can. It's just kind of a glitch in the software. The thing to understand here that I like to show is that, you know, as we look at this, we've got, just to kind of give a summary, we got $200,000 going in year one, $24,000 year two and beyond, up through year 7, and then that drops down to, like I said, $22,885. And there's no loans in this policy. Now I'm going to show another policy that's exactly like this one, but it's going to show loans coming out of it. Okay, that's important to understand. The dividend rate assumption on here is 5.75. And the 76-year return, or the age 76. So at age 76 in this policy, which is like whatever, 36 years out, the internal rate of return after net of all fees, insurance costs, all that stuff is 4.4%. And so when you look at the net equivalent, that's about a 5.5% taxable equivalent. Okay? So that's important to understand when we look at the long-term internal rate of return of this and being able to leverage it the whole time, right? So when we look at life insurance, when we look at these kinds of policies, it's important. We're not comparing this to an investment like the S&P 500 because it doesn't have the same risk profile as the S&P 500. We're looking at this as a storage vehicle, as a banking alternative, as a savings alternative compared to CDs, compared to bonds, compared to high yield savings accounts, compared to those types of assets. That's the key. That's what we're looking at here, okay? And so in this, when we look at this, now we're saying, all right, this is assuming the current dividend rate assumption of 5.75. It's non-guaranteed, okay? That 5.75 is non-guaranteed. Well, how do we get to the non-guaranteed dividend assumption? Well, first of all, if we look at this as non-guaranteed, so everything in this net cash value column is not going to be guaranteed. The guaranteed column is over here. Now, the problem is the guaranteed typically, I mean, is never coming into the equation because this company, for instance, has been in business for 120 years. They paid a dividend every single year for those 20 years, or for those 120 years, right? So there's two variables here. We are looking at the fact that they're going to pay a dividend, and the other component is we're looking at the fact that they're paying a dividend at this year's current rate, which is this 5.75 number here. So if dividend rates go up, well, then the performance here is going to get better. If dividend rates go down, well, then the performance will get worse. It's really important to understand, but following the market is really, really important. Following the trend, because when we look at why whole life got a bad reputation, this is kind of something I like to show because I think it's really important for people to understand. When we take a kind of zoom out look at this, back in 1980, federal funds rate got jacked up to like 19%, right? And what happens is here, the blue line is dividend rates chasing the federal funds rate. Whether the rates are going up or down, there's this inflection point, and whole life rates ended up going up and following, kind of trailing, right? Tapping out a little bit below where the federal funds rate is. And then as dividend rates went down, as the federal funds rate went down, dividend rates trailed. So what's happened is over the past 40 years, we've had this world where everybody thinks that whole life insurance is all about positive arbitrage, but that's a principle that is just not true. That was circumstantial, that was environmental. It's not principally baked into the product. And I think that's one of the reasons people are confused about this, because they don't realize it's not principally how it works, right? And then what we have here is the inflection point going the other way. So now as the federal funds rate is going up more, the dividend rates inflected. Now they're going to chase, the dividend rates went there. Now they're going to chase up. So now what we have is we have a life insurance environment where we're not going to have positive arbitrage. We're going to have like a negative spread in there as rates chase up, just like we had a negative spread back here. But this is the thing that most life insurance agents don't want to talk about. But the problem is they're missing the opportunity. And the reason they're missing the opportunity, and Tom Wall says this really well, is that right now is the best time in 80 years that we've had to buy life insurance. Why is it the best time in 80 years? Because this dividend rate that we're talking about right there, that 5.75, is near the lowest in 80 years. So when we look at that, when we think about the fact that this dividend rate is near the lowest that it's been in 80 years, and we look at the fact that this non-guaranteed assumption is based on the fact that this is saying it's banking on the lowest dividend rates that we've had in 80 years. Well, if this rate goes up, that gets better. I'm not saying that's what's going to happen, but I'm saying when we look at the downside, like hedging to this, the chances of this being worse than what we're seeing are very low. There's very little downside chance of this. And if there is downside risk, it's not going to be much worse, right, than what you're looking at. But the opportunity for it to potentially perform higher is actually pretty significant when we look at long-term averages. All right, Andre, what's going on, man? Ledesma. When it comes to bonds, you have to liquidate the full bond. Then you face reinvestment risk plus taxes. That's so true. So you get this as a bond alternative, and you don't have that risk. The insurance company is carrying all that. Not to mention, you can't lose in this. There are bond funds that have lost money. The whole 60-40 portfolio concept has gotten blown up because of the fact that the market has actually lost value and bonds have lost value in the same year twice, even though that had never happened before since the 60-40 bond portfolio concept had been created. So one of the things that I did here is this illustration, and we'll get into it more, But this illustration has no policy loans, right? So I'm showing this. I just wanted to show what it could grow to, right? By the time the individual hits 72, right here, right? By the time that person hits 72, right there, you got $2,274,000, right? And a $2,979,000 death benefit. So the cool part with this, guys, do the math here, right? If you go here and you say, all right, what is that? This is where Tom Wall says you got permission to spend, because this is a way to create like extra value, extra legacy. I could pretty much spend down $2 million here, or 2.274. Let's say I spent pretty much all of it and I did it max efficiency. I'm still gonna have a 700,000 in change death benefit that goes to my heirs even after paying it off, right? I'm still gonna have 700K left over even if I spend that cash value down. So it's really, really powerful, right? Now I'm going to go to the next page and we're going to talk about this, and you could see what I was talking about here earlier. Right here, you got the net cash value of $2,792,000. That's a 4.4 return, which is the equivalent tax return, or a taxable equivalent of 5.5%. That's why we say this is a bond return, the equivalent of a bond, right? So you just don't see it? What don't you see? So Mash, tell me what you don't see. I don't understand what you don't see. Be more specific. If you don't see something, I'm totally down to go into deeper conversation. If you need a lot of convincing, I mean, I'm not really interested in convincing anybody on anything. Well, if you took, how old are your policies, first of all? And if your policies are only returning 2%, my guess is you didn't design them properly. They're not the right blends. Okay, that's cool. If you've read my book, I don't know. Like, I don't get into a lot of detail about this in my book. That wasn't the purpose of that book. If you read the Cashflow Hacking book, that wasn't the purpose of that. That book didn't really get into that. I mean, you have to make sure that you are designing the policy properly. I mean, look at this policy. You can see here, we put in $200,000 year one, and you got $187,000 net cash value. So it's like 93.5% liquidity, right? So your policy's 15 years old. Is that what you said? Is that what you mean? Your policy's 15 years old, and I don't know how you funded it. I don't know what your blend is. I don't know what company it's with. What company is your policy with? My guess is if it's a 2% return, it's not with a big major mutual. Or if it is, it's definitely designed improperly, which I don't know. Not yours personally. Are you talking about policies you've looked at? I don't understand, I guess, the point. I'm not sure like what you're really getting at on this. So, keep engaging, keep asking questions or making comments, and I'll do the best I can to engage and answer. But I need more specifics if I'm going to be able to dive in and answer any questions. All right, no worries, perfect. But I'm here. I want to help. Like, I want this stuff to make sense to everybody. It's really important to me. I don't ever expect anybody to put money into something that they don't understand, right? You can see here that the initial death benefit was $203,000, $176,000 of dump in front load, right? So when people go, oh, it's not fair, the life insurance company keeps the cash value, but you only get the death benefit. Well, your original death benefit, why is that not working? Come on. There we go. The original death benefit was only $203,000, right? So if we look at that and then we go, all right, I've got, let's go down here where it's like 3 million, right? I've got 3 million. I've got $3,677,000. So that's like an extra $630,000 of death benefit, right? So that's 400,000 more than what they originally bought. And that is because the fact that they're making it so there's a taxable advantage when this money's increasing. They have to lump it together. They could keep it separate, but to say that the life insurance company is keeping the cash value and only giving the death benefit, they're having the death benefit grow as your cash value grows, right? But the death benefit still gets bigger than the original death benefit that you bought. Anybody that doesn't explain it that way does not understand. What's cracking, man? I got somebody from TikTok to come over. That's pretty exciting. Can you believe some clown Primerica agent reported me? It's so obnoxious. I cannot. It's really, man. It's like TikTok is really starting to drive me crazy. But anyway, so that's what's going on. So we got that, right? Now what I want to do is I want to bring you over here. I have the same illustration, okay? No, Mash, totally. I get it. I'm good. I'm good. Like I'm totally down, Mash. I know you're not clowning me. I want you to understand this stuff. I get it. If you have questions, I'm never gonna berate anybody for asking questions. When you say the blend, what do I mean? I've had high cash value policies with Elon Mutual. Elon Mutual is not a company I've ever done any business with. I'm not sure Elon Mutual, honestly. That's not a company I've ever dealt with. But when I talk about high blend, I'm talking about you have base and you have paid up additions, PUAs, which is paid up additional permanent insurance. Okay. So when we look at base, this is the base coverage of, this is basically what people say is whole life. So when you look at a whole life policy and we say, when we say, hey, it's got zero cash value in year one, you're pretty much 100% base. If it's got zero cash value in year one, those are the policies that the Dave Ramseys and the Primerica agents of the world love to hate, right? Like that's it. The paid up additions is what goes into cash value, okay? And so we're pretty much structuring, like this policy is structured predominantly for cash value, okay? I designed this for a real estate investor because having this early liquidity here was absolutely essential. So we put in 200,000, you get $187,000 net cash value year one. That's 93.6% liquid year one, right? So that's what we designed this for, is because it's important for the person. They wanted to invest in real estate because, once again, the purpose of this video today is to show you how to utilize whole life insurance to invest in real estate, because that's what Cashflow Hacking started off as. It's expanded from there, but for me, my wife, for us, for our wealth creation, this is what we've done. We've utilized whole life insurance to invest in real estate. So now I got $200,000 going in, right? I'll highlight some things. We got 200K going in. We've got the 187,000 year one. And let's say it takes Elko Mutual and Mutual of Omaha. Yeah, so those are not good whole life insurance companies compared to other companies that we work with, compared to other companies that really focus and specialize on this sort of stuff. It is what it is. 70-30 split illustration for 100K premium, 20 pay. So I can't do that on my Vibe board. Otherwise, I would do it live for you. But if you want to like go through it, Professor, we could do that another time, for sure. 100K premium, 20 pay. Why do you want to do a 20 pay? So the thing with the 20 pay is like you're stuck at 20 years. Like you cannot pay longer than that. One of the things I like to do is typically use a longer pay chassis. And then when you get to year 20, it gives you the flexibility. If you want to RPU the policy, you can. If you want to keep paying on it, you can. It gives you the flexibility. If you do a 20 pay, you're forced to stop paying that premium when you hit that period of time. And if you're not insurable to get more insurance, you can't get another policy. And let's face it, at year 20, as an example, with this policy right here, year 20, actually, this is not, I got to go back here. So at year 20 right here, right, we go here, this blue line, right? So at year 20, I'm putting in 22,825, right? And then at the same time, my increase in net cash value is 72,119. So why would I ever want to stop putting money into an asset that's yeah, you can stop paying the PUA at year 20. You can RPU the policy, what's called reduce paid up. You can reduce the coverage, which is a partial surrender. So if you RPU, so like at this policy right here, let's say the blue line is the last year that we want to pay there, right? We could technically say, all right, that's it. That's it. We're done. Then at that point in time, we say no more premiums. It's going to zero out, right? But the difference is this number, the death benefit, is going to get reduced, right? So it's reduce the death benefit, fully pay up the premium. This is one of the powerful things of whole life insurance that most people don't know. You cannot do this with IUL. You can show zeros in the premium column, but even though there's a zero there, it just means it's a vanishing premium. It doesn't mean that that there's no cost coming out. The costs are phantom costs coming out of the back end of the cash value of the policy, right? That's the important part. So Derek, yeah, the companies that we work with allow you to use this money, that 187. You have access to 90% of that within about 30 days, right? So that's important to understand. You have access to that really, really fast. And so you probably missed the beginning, but look at this. I got 272 in year 4 this is my cumulative premium that I've put in there. I've got $278,000 right there, net cash value that year with a death benefit that goes above and beyond that, right? So you can't make this there's not another asset that will do this, guys. Not another asset. So if you want to learn more about this, by the way, you can click on the link in the description below and you can set up a call. Anybody that wants to set up a call, there's a Clarity Call link. Go down there, check it out. My team is happy to help. I'm happy to help. And so I've gone through this page. Now let's go into this because this is where it gets fun. This is where it gets really exciting, in my opinion, is that we're talking about, this is the same illustration, same assumptions. You can see everything has remained the same. And you can see down here, remember I showed earlier, for those of you who are just getting here, that at year 32, which is age 72, you got 2,274,000. I'm going to go back and I'm going to show you at the beginning there, 2,274,000 right there. Okay. So the same thing. But remember, in this policy, this illustration, there were no loans taken out of it. So now what am I doing? I'm going to go here and I'm going to take loans out of it. So you could see the increase in net cash value. You're taking negative, you could see the negative 78, negative 64, negative 58, negative 52, negative 45, negative 37, right? So one of the things that I'm doing here is I'm utilizing the cash value as a down payment for turnkey real estate, for cash flow producing real estate. What you can see here is that I have, with this first loan, I bought 2 houses. Okay. Now, one of the things that we're doing is obviously with this, you can reach out to Matt. You can reach out to me too. You can reach out to me as well, man. Or you can email chris@life180.com. Anybody that wants to email me personally, chris@life180.com. If you got direct questions about this, I can get you directly on my calendar that way as well. I like to work with people and make it easy, right? So we got 2 houses that we're buying here. So our assumption is we're buying a $200,000 rental home. By the way, I'm utilizing these numbers specifically because these are the numbers of the turnkey properties in the system that my mentor, Mike Wolf, has in the Kansas City, Missouri area right now, right? And by the way, anybody that's watching this and you want to see Mike Wolf talk and you want to learn more about all this stuff and be able to be in person, you can come to the event, the Aligned Wealth Experience in Scottsdale, Arizona, August 21st through 23rd. We're going to be there. Check it out. Once again, if you have any questions, email me and go from there, or there's a link in the description below to learn more about that event as a whole. And so here we go. What we're doing is we're taking $200,000 homes, we're putting 25% down. So we're doing 2 of them. That's 25% down. That's $50,000 down on each house. That means we need to take a $100,000 loan against the policy to buy 2 properties. Okay, that's what we're doing. We're buying these 2 properties, $100,000 loan. You can see that the net increase in net cash value is negative 78,000. So then we add 24,000 to that, and you could see that means it's about $2,000 negative in that way, which sounds bad, but once again, that's because we're doing this early in the policy. There's a little bit of a premium to do this on the front end, but in the long run, it's going to go a long ways. You're in Kansas City. Do you live in Kansas There we go. Internet came back. So that's awesome. Oh, that's awesome. You live there. Yeah. So we're doing investment properties in Kansas City now. So you understand the prices then. Like I could buy properties in Chandler, Arizona, Gilbert, Arizona, but the prices are going to be crazy compared, and the cash flow is not the same. So we're assuming an 8% cash flow, right? And so that's one of the things that we're doing. We're like, I just want to explain to you, and I'm going to show you. I built an Excel sheet on this, okay? But year 2, we're buying 2 houses. Year 4, we're buying 2 more. Year 6, we're buying 2 more. Year 8, we're buying 2 more. 10, 2 more. 12, 2 more. 14, 2 more. And then 15, 2 more. So what does that mean? That means in 15 years, we've purchased 16 houses that are cash flowing, all with the cash flow that's going into our properties, okay? And so by doing that, what are we doing? We're going to utilize the 8% cash flow from the property to recapitalize our loan every time. That's how we're paying the premiums and we're paying back the loans. We're paying the premiums out of other income, other active income. We're actually just starting. I don't know where the property is located because I'm buying the first one right now there. The rest of our stuff is in Atlanta. We're just getting to the Kansas City market right now for the first time. We're in. How do you get that many mortgages? It's called a DSCR loan. And there's actually a lot of people on TikTok that do this, but it's an investment loan. So basically what you do is you take the income, each property is a business, and you have it rented, and you buy properties with cash flow, and you take the rental income, and it actually can be utilized as income for the mortgages. That's the power of this, right? That's the power of how this works. You leverage whole life insurance for the down payment, and then you get a DSCR loan for the balance of it, and you're going to be cash flow positive. So that's the only variable to this is you need to buy properties that are cash flow positive, right? That are cash flowing a high enough percentage that you can service both loans, right? They're going to pay down your mortgage. You're going to get the tax benefits, the depreciation, but you're also going to get the appreciation from the properties, and they're going to pay back your policy loan. And as you pay back the policy loan, you recapitalize the liquidity of this account. And then the faster it goes, the more you can use. Now, once again, by paying all these loans back, you can see even at year 72 or at age 72, year 32, we've got the same amount of money that we had in the other policy that we never took a loan from. Why is that? Because we're using this 8% to pay the policy loans back, right? And if we pay this 8% to pay the policy loans back, and as long as we manage those loans properly, it never impacts because this is a non-direct recognition company. And so think about it. This is what people don't understand. Now, because of the system that I've used, because I've been able to save money, but save with the intent of investing, buy real estate. Now I'm using OPM, other people's money, to pay down my properties. I get the tax benefits. I'm getting the growth inside the policy uninterrupted. I'm buying and I'm creating leverage by never interrupting the growth of the money that I use for the down payment of the properties. And then I'm leveraging other people's money for the bank loan, right? Aren't you netting zero for cash flow then? Well, yeah, no, dude. So this is the thing. I am not doing this to live on cash flow right here. I'm using all the cash flow to service the loan and to recapitalize the account, right? That's what I'm doing. The money goes in here and I'm recapitalizing these accounts to get there. I'm not living on any of this, right? Because this, you notice there's always cash here, even on down here. So those are the like the escrow accounts or the servicing accounts for like if anything breaks in the property, if we need to replace a refrigerator or something like that. Property management deals with it all, but we got to have money there just in case, right? Like if we need to replace a roof or something like that, we have that. We got to have that covered, right? That's something that we take into consideration. And so you're not gaining anything, but here's the deal. I'm going to go through this. Let me see here. So I want to show this. This is really powerful stuff because you can see here once again, it's the same at age 76 when the policy is fully paid up. No more payments, no more fees, no more nothing. You still have the same cash value in this policy that you had in the other one. And so now you get done. You have 16 homes at this point in time. The cash flow in retirement that 16 homes will provide you, plus you have this $2,792,000 as a volatility buffer. That way, if the market goes down or anything, you're protected. And you have $3,451,000 of death benefit, which is basically like an extra $700,000 above and beyond the cash value. So even if you had to spend the cash value down, you got $700,000 legacy to pass on, right? Does that make sense? Can I get ones if that makes sense? Twos if you're confused, or if you're really confused, give me specific questions. And then I'll move on to the next phase. Annual premium is $24,000 for the first 7 years, and then $22,825. So basically just under $2,000 a month going into it, right? If that's what you wanted to do. All right, so we're good. That's a 1. Okay, we got people understanding. So this is what I want to understand is like, it's really important to understand the concept of compounding versus amortized debt, right? So if I look at year 1, this is the people that don't understand how this works. They're like, why would I pay 5.5% on a policy? And by the way, I showed that this policy did 4.4% net, right, over the long period of time. If you're just getting here late, I showed how that worked, okay? Now, the question is, why would I pay 5.5% on a loan and only get a 4% return? Why would I do that? That makes no sense. And so I'm going to give you an example. Year 1, okay? If we go year 1, then we have a 5.5% loan, okay? If I got 100,000, well, hold on one second. I don't know why it went to 8,000 there. I wrote 8,000. That's a total. You're not borrowing your own money. You're borrowing against your policy. I'm not borrowing my money. So here's the deal. I'm not borrowing my money, because if I were borrowing my money, I wouldn't be able to have the money keep growing in the account. I'm borrowing against my money. I'm using this account as collateral to get guaranteed access to money from the insurance company. Now you can go and you could put it in a bank, and you could get a collateralized loan against a savings account from a bank, and they're going to charge you a little bit of a spread, right? So if I went to a bank and I had $2 million in an account, the bank would give me a loan against that account value, and it's going to be comparable, but the difference is that that account is just not going to grow as fast. You're not going to get the extra life insurance. You're not going to get the living benefits. So you are not borrowing your money. You are borrowing against your money. Does that make sense, everybody? Does that make sense? And so when we get here, here's the thing. We have, 5.5, I got where the 8% was, or $8,000. What we're doing is we have 5.5% right there is $5,500, right? And so we're paying the $8,000 here because we are paying 8% of cash flow, right? So 8% cash flow from the property. So if we're doing 8% cash flow from the property, that's $2,500. So if I take a $100,000 loan and I'm paying 5.5%, that's $5,500. Well, I'm going to take $8,000. I'm going to pay it back. Why is that important? Because next year I've only got $97,500 as a balance, because I took the extra $2,500 that was above and beyond the interest servicing charge that goes to the insurance company. That $5,500 is not paying back yourself. That's going to the insurance company. The $2,500 is paying down the principal. Okay. And so now instead of owing $100,000, we owe $97,500. And so then that year with 5.5%, we have $5,632 is the payment. And then it goes down to 94 is the balance, 92 is the balance, 89 is the balance, and then 86,000 is the balance year 6, right? So when we look at this, now I go, well, why would I, once again, I'm re-solidifying, why would I take a loan at 5.5% and only earn 4%? Because compounding in this account is better than declining amortization over here, right? That's it. So look at this. Here's why. Because we're behind year 1, because I got 100,000, I go to 104,000. I'm only earning 4,000 when I'm paying 5,500. I'm only earning 4,160 when I'm paying 5,362. I'm only earning 4326 when I'm paying 5217. But here's the deal. I go down year 4, year 5, but year 6, I'm paying 4732 and I'm earning 4866 on the 4%. So it's only like if I'm doing a 30-year mortgage on these guys, if I'm financing these properties over 30 years, which is what you absolutely should do, right? You're looking at a 4,732 in your that you're paying in interest on on a 5.5% assumption on the interest expense, and you're earning 4866 at only 4%. Okay, so when you look at it like that, that's 24 more years of this gap getting bigger and bigger, with the 4% number getting better and better and better, and this 5.5% number getting lower and lower and lower and lower. This is how you create wealth. Now, a lot of agents don't explain it this way. They just try to say, hey, you get arbitrage, you borrow. They'll try to tell you you borrow at 5.5% and you're going to have a 6% dividend. Well, I got news for you. Even with Lafayette, for instance, they'll say you borrow at 5.5 and you'll earn 5.75. Well, that's not the way it is either. Like, you have to realize it's not about the positive arbitrage year one. It's about the system and looking long term and understanding money math and how that works from a long term perspective. You know what I mean? That's the part that matters the most when we're talking about this stuff. Does that make sense to everybody? Give me a 1 if that makes sense. And we're going to move on, right? I did another video on here, so I got some other notes that I have going on here. But that's the first loan. But the principal, you just rinse and repeat. That's the first loan. And then when I take another $100,000 loan, that loan follows the same cycle. But every loan is going to go through this. And over a 30-year period for each loan, the principal doesn't change, right? So by year 6 in every loan, we become absolutely positive. And the goal here, this is the thing, guys. We need to be realizing that we're doing these systems and we're retiring. Think about it. If you put your money in a 401k, what are you doing? You're hoping that 401k is going to be what you're hoping for 30 years from now, right? That's the goal, right? No, the loans are not fixed rate. The loans are variable. They could go up, they could go down. But what happens with loans in whole life is as the loan rate goes up, so too do the dividend rates, right? So there's always going to be a relative correlation. That's one of the reasons that you want to use whole life insurance with this and not IUL, because IUL, that's not the case. And so these principles don't work that way with IUL. And it is what it is. But we're looking at this, and the spread is typically very comparable, right? And so what we're looking at here is we're looking at a 30-year period. We're looking at a 25-year period because it's not a matter of right now. It's a matter of 10, 15, 20, 30 years from now. Are you going to be getting the best results that you want? Are you going to be operating as efficiently as possible? And once again, are you willing to be a little bit on the upside downside of it, right? Paying a little more in interest for the first 5 years, 6 years, and then to earn more, a lot more, in a compounded fashion for the next 25? If the answer is no to that, then you're in the wrong place. This is not the channel for you. I'll tell you right now. If you don't like paying a little premium for five years or so to get benefits for 25 years, well, I mean, that kind of math, I don't know what to tell you, right? And so this is my spreadsheet that I kind of built, and it shows more of the math of what we're having here, right? So just kind of break it down for you here. We've done this, the $200,000 front load, right? And then the premiums. Then you can see the policy loans that I took out, right? And I just exported this, by the way, from the insurance. And then we have the total loan payments every single year that we're paying. Because what are we doing? We're taking that and we're paying it back. I got a $100,000 policy loan. I got $8,000 because I'm taking the cash flow. It's 8% cash flow from the property. That is my assumption. You could have higher cash flow. We got some properties that have 14% cash flow, right? So if I had 14%, I would absolutely take that cash flow, pay it down faster. That makes the numbers even better, right? Because remember, You're not paying yourself back. You're paying the insurance company back for the collateralization of that loan. So you always want to pay it back as fast as possible, right? So 8% of the 100,000 is just the assumption that I'm doing. So now I got a 200,000. I've got 16,000 because I got another 8% of that extra 100,000. 8 plus 8 is 16. 8 plus 8 plus 8 is 24. Plus 8 is 32, 40, 54, right? It is what it is. That actually should be 56. That was a typo on my end because anyway, that is what it is. So, and then it gets down to 70. It should actually be 72. So that's my bad. I must have screwed that up somehow. But it's $2,000 out of the grand scheme of things. It's not going to be that big of a deal. That said, it shows the total loan balance with the assumptions with the policy loan interest expense. Because by the way, the example that I used to show the 5 and the 4.4 or 5.5% and 4%, that's not real life. I use that as an easy way to communicate because the numbers are round. The reality is this loan balance is showing a 7% loan rate. Since then, the loan rates have come down, and it's showing what this looks like even with the loan rates being the highest that they've ever been, right? And so when we look at this, now we see the loans, and we're using this cash flow to pay back the loans. And so at age 70 now, and I'd like to see any financial strategy with the S&P 500 do this. It's just not going to happen. You're going to have a zero loan balance. That means you own 16 houses with no loans on your policies. You've got 2 million cash value at age 70 right there, right? 2 million in cash value, no more policy loans, and you have 16 houses with a property value of 6 million, right? Now, if you were to take the 200,000 and you were to invest it in the S&P 500 and compound it at 8%, that's $216,000 year one, and then it keeps compounding by adding the 24,000 every single year, and then the 22,825 every single year, and you grow it by 8%. You're going to be at $4,633,000 by doing what I just showed you with what I call cash flow hacking, by saving money in a whole life policy, borrowing against it, buying turnkey real estate, going down. You've got $2 million of cash value inside of the policy and $6,179,000 of property value, right? So now you are going to have some mortgages out of this, so it's not all pure net worth. But once again, your tenants are paying the net worth on it with that. What did this strat? I don't understand. Did you do this strat in 08? Curious how this would fit. Yeah, so my mentor did this all through 2008. That's actually when he doubled down, because in 08, what happens when the market goes down? Cash flow matters more. You have access to capital. And so when you have access to capital, when real estate goes down in value, now you're just buying more properties at depressed levels, right? Exactly. Yeah, and by the way, yes, we had properties in COVID. We had to go through it, and it was no problem. It was no problem. For the loan arbitrage into work, do you have to buy income-producing assets? Yes, you absolutely have to buy income-producing assets. That's the biggest. Okay, I'm gonna do this. The biggest thing that I have right now that I can't stand that's happening on TikTok, on YouTube, on all these things, is the fact that people are doing videos saying you can make money buying cars, you can make money buying depreciating assets. Nothing could be further from the truth. Now, if you're saying, hey, I'm gonna buy a car, and I'm going to buy that car anyway, well, then using a policy loan is going to be the most efficient way a lot of times to buy that car. But you have to understand what metrics and variables go into that decision, right? I'll do more videos on that later. People say, yeah, I know, bro. Like, yeah, tell me about it. Tell me about it. Sounds like an IUL agent. No, it's also a lot of infinite banking people are starting to say that you can make money buying cars. I've seen influencers making videos on how they made $100,000 buying a Porsche, and it's honestly, it's batshit crazy. It just is. So anyway, so let's get to this, right? So what do we have here? We got 6 million in property value. And by the way, this is assuming a 3% growth of the real estate, right? So we're not even assuming the property growth to be out of control compared to the market. Like historically, real estate goes up between 3 and 5%. So I picked the number at the bottom end of that to get to this number, right? And mind you, remember, think about the cash on cash return, because all I'm doing is saving this money every year. That's my saving. So when you look at the cash on cash return, the fact that out of your pocket, you're taking active income right here, that's what you're saving. But all of this money that's getting paid back by paying back the loans every single year is coming from your tenants. That's important to understand. And so then what we do is we look at 6,700,000. It's like 16, 24, 32. It's like 300. What is the number? I should have written it down ahead of time, but I think it's about $360,000 per year is the cash flow that comes from this. If I remember that, 8% of the 6 million there, it's about $360,000. So 8, 16, 24, 32. No, it's higher. It's like 480,000. But let's just say it's like in that range, right? I mean, it's between 360 and 480, right? Is like what we're talking about. Yes, right. Yeah, we only use participating mutual whole life insurance. No IUL, no life insurance with companies that are not participating mutual companies. Okay. But what we have here is we got $8 million in net worth, right? But more important than the net worth, it's the cash flow that this produces. Okay. And when we think about legacy, which, listen, to me, it's really important. I realize to a lot of people it doesn't matter, but to me, legacy is important. So we've got the net worth at about 8 million here, right? But more important, we have the cash flow that we can live off, right? Without tapping into or destroying any of this. We have this as a volatility buffer if we want it, right? During retirement. If the market gets depressed, if a 2008 happens and some of this dries up, well, you have this money to weather a couple of years of bad times. Or if what happens to you happened like what happened to my mentor, where cash flow is still fine because people need a place to live, right? And his net worth went down, the property values went down, his cash flow stayed the same. He was sitting on liquidity and he bought properties at 30 cents on the dollar, right? I have a team that finds properties for us. One of the things that I do is anybody that wants to work with us and do this, I can plug you into my team that I use, right? Like that's it. They go and they buy 30 to 50 properties at a time. They fill them, they put a renter in, they get the leases, they put warranties on the houses, and then they sell them as cash flow producing assets. So I plug people into the exact team that I use personally. Okay. That's what I do. If anybody's interested in learning about that, whether you do a policy with me or not, I'm happy to plug people into that whole system because I just think it's the best way to build wealth. Right. So when we look at this though, it's double what the S&P is when you break it down. The 6 million plus 2 million is almost double the 4,600,000, right? Right? And so like this is massive, okay? And then when we break this down even more, guys, think about it this way. This 6 million here, your family, your the inheritance, because remember, you also got this $2,755,000 death benefit. So if all you do is live off this cash flow, now what you do is you pass these properties on, you get a complete step up in cost basis to the next generation, plus they get this $2,755,000. So if you go, I'm going to go to the next page here, and if you make it even just to 76 here, and you're talking about $7 million with 3.4, you're leaving almost an $11 million estate. An $11 million estate, and you were able to live off the cash flow the whole time. So I don't know how anybody doesn't get this. Like the part that's mind blowing to me is the Primerica agents that do this stuff with the buy term and invest the difference, and they try to act like that's what's going on. The thing that I didn't even touch on this vibe board, on this presentation that I just kind of gave, I didn't touch on the fact of all the tax benefits that you get, the actual tax deductions you get, not tax deferrals like a 401k, but actual pure tax deductions because of the way that you're able to use depreciation, bonus depreciation, accelerate the depreciation, all these different things that you can do, right? Super, super powerful. I don't know another more financially efficient way to go about creating wealth. Yeah, if you had liquidity in '08, there were generational buying opportunities. That's it. So, but that's the thing. '08 is going to happen again. Give me a 5 if you think '08 is going to happen again at some point in time, right? Doesn't have to be, uh, doesn't have to be now, or like anytime soon, but sometime in your life. Do you think an '08 is going to happen again, right? If you think it's going to happen again, don't you want to be prepared for it? That's the way I look at it. That's why I think it's so important to have an opportunity fund. Let me ask you what they would ask you. Where could things go wrong? What's the catch? What are the things we need to consider? I believe in it on a lower scale. Okay, so, well, I mean, I think the principles are if you believe in it, you believe in it. If you don't believe it on a bigger scale, then I would say that's a self-limiting belief. The principles are the principles. It works. The risks, though, I would say, are that you need to make sure that you can fund the premium for at least 7 years, right? So if you cannot fund the premium for 7 years, then you probably are funding it at too high of a level. I think it's really important. The biggest mistake that I see people make is they work with agents that get them all hyped up and they try to get you going into premiums that are way too high, and it's too stressful. These assets, when you do it properly, should always be a value add to your life. They should never be a stressor, right? So like when you look at it, the way that I think about it is with a life policy, if you design it properly and do the blend, like in this situation, the $24,000, you could pay on that premium the way that I have it designed. You could basically pay anywhere between $8,000 and $24,000 every single year, right? So if things got rough, if I were selling you a premium like that, for instance, and getting you set up with an account like that, I would say if you're not able to, even on a really rough year, have enough savings that you can cover $8,000 in premium, in the worst case scenario, that means it's too big of a policy for you. You shouldn't be doing it. Right? That's it. And so the biggest risk is the first 7 years where it's before the period of time where you can do a reduced paid up on the policy. Because anytime after year 7, if things get tough, you can always just RPU the policy, do a reduce the death benefit, pay up the policy, pay up the charges. There's no more cost, no more fees, no more nothing. And it will be like a bank account on steroids, right? With all these other benefits. There's nothing more efficient long-term for safe money, safe, liquid, accessible money. There's nothing like it. You just got to get through the 7 years. That's the biggest risk. And the other biggest risk, I would say, is from a perspective of what people are, I guess, pitching on social media, right? That's all I could talk to. The other biggest thing would be taking the loan here and not paying it back, not using the cash flow to pay it back. If you take early loans in these things and you do not manage the loans and at least cover the interest expense of the loans, it will blow up in your face eventually. You cannot take early loans at a policy. Now, if you did no loans or you had like all your loans managed and paid off, and then at age 65, let's see if I can not have it blurry, at age 65, you took a loan for retirement, or something of that nature, well, then that's fine. That's going to end up working pretty much just fine, even though I would say typically if you don't plan on paying the loan back at that point in time, I would always do a withdrawal up to cost basis, because by doing a loan, all you're doing is you're leveraging and guaranteeing the loan by the death benefit, but you're adding interest expense that goes with it, which is just inefficient. Now, if you ever plan on paying that loan back at age 65, well, then take a loan. But if you don't plan on paying it back, you want to do a withdrawal up to cost basis. So you can see here, what is cost basis? Well, cost basis is your cumulative premium. So at 65, you can see cost basis is $754,000. So I would withdraw and do a partial surrender of $754,000 before, up to, right? If I had to do a couple $100,000 a year, one lump sum or smaller, any number under that cumulatively, I'm doing a withdrawal, not a loan. if I get later in the policy, because everybody's like, well, why would you want to reduce the death benefit? Well, I got news for you. Taking a loan is reducing the death benefit because the death benefit's guaranteeing that loan. Does that make sense? So we want to make sure we're always doing this in the most efficient way possible. Hopefully that makes sense to everybody. Any questions? Any questions? Was that helpful? Did that explain things? Fixed income annuity distributions pay off the HELOC. What are we talking about? I missed some comments. Leverage a fixed income annuity and fund the brokerage and buy real estate. Yeah, but your fixed income annuity, your fixed index annuity is not going to pay enough cash flow to do all that typically, right? It's just not. Is the interest rate on the cash value variable or fixed over time? It's variable. It's variable. So the loan rate on whole life insurance policies typically follows the Moody's bond index, right? And so like if you follow the Moody's bond index, that will pretty much track loan rates. Now, when we look at that, that's typically going to impact the dividend rate as well. So if interest rates go up on loans, the dividend rate's going to go up. So there's always going to be a correlation between the two. And typically, the rates are like when the rates are going up, there's a lag on the dividend rate. So it usually is an 18 to 24 month lag. So that's the only challenge. If rates are going up, here, I'll show this. If rates are going up, then whole life is trailing and it's following up. So let me see if I can draw this. So, okay. So if we look at that, right, and we say that that's the federal funds rate, right, and we say that the federal funds rate taps off here, and up here, that the federal funds rate is 0%, and let's say it's like, I don't know, 7%. It doesn't matter. It's the principle here that matters, not the percentages. Okay, and so then what happens is we say, okay, what's going to happen is dividend rates. So if that's the federal funds rate, dividend rates are going to trail. They're going to go like this. They're going to go. So what you see here, as the federal funds rate is going up, the dividend rates are going to follow up. But then as the federal funds rate goes down, the dividend rates are going to follow it down. And so in different economies, this is the thing. And remember, the federal funds rate from 1980 to 2009, because they were so high, it was at 19%, it went down, right? We had this low rate. And so dividend rates chased it down for 40 years, 30 something years. And so because of that, there was this environment where there was this positive arbitrage. And because it lasted for 40 years, everybody thought that was just going to be forever, right? And they thought that that's just the way it worked. I majored in art and whole life. Perfect, exactly. But right now and before 1980, when that happened in the 70s, this is what happened, right? We had an environment where, and I got to get my other color here. Red is bad, right? Red is bad. We're going to do that. So we had an environment where there was negative arbitrage, right? And that's not bad because once again, we're buying these assets to solve problems over long periods of time. In negative arbitrage environments, we're utilizing this policy for different reasons because even though it's negative arbitrage, there's cost of capital that you can control. Does everybody understand what I mean by that? Because cost of capital, this is one of the most important things. Controlling cost of capital is more important than what your rate of return is because it's going to impact a greater portion of your volume. When did Walt Disney leverage his whole life to build the castle? It was like 1940 something, I think. 1940 something, 1950 something. But the cost of capital, let me give you the example right now, is for rental properties. What I was showing. So what are rental property mortgage rates right now? You're talking about 8 to 8.5% on a DSCR loan, right? With 25% down. So if I can get a policy loan at 6.7%, that's, 15 to 20% less than, these numbers, right? And so if I can reduce my cost of capital by 15 to 20% on every rental property that I buy from a down payment perspective and never interrupt the growth of that money, that's how the cash flow hacking process in this spreadsheet, that's how it produces all these results, because I'm controlling that cost of capital. Hopefully that makes sense. Okay, so the general account is also not 100% bonds. Correct. It's got private equity, credit, mortgage-backed securities, real estate holdings. Yeah, partnership equity that pays. So here's the deal. Am I ballooning the loan for 3 years? No. No. Sometimes we do 3-year lease options for our tenants, just to get better tenants and to have a higher quality thing, but we're not ballooning the mortgages at all. No. Standard 30-year DSCR loan. That's all we're doing. Yep. Now, if rates go down, you can refinance those rates over time, right? And it can work really well. It is what it is. Yeah. What's a good idea? I didn't understand. I don't understand what you're saying. What did I say that was a good idea? I thought what I just said was pretty basic, but maybe I don't know. It's just what we do. But we do 3-year lease. Was it the 3-year lease option? Right? So we do 3-year guaranteed, set the terms for the appreciation with a set price. 3 years out, we get better tenants in, we get bigger down payments, they treat the house better. Yeah. And then, and the crazy part is people want it because they want to have the vision of being able to buy a house and listen, you're setting them up to do it, but they treat the house better, they give better down payments, you have more security in the property, and we've only had one tenant ever actually buy the house at that period of time, right? And so it's a really good strategy. You can look up lease options on YouTube, and there's a lot of stuff out there. How do we vet our tenants? We have a property management company that does all of it. I've only seen one of our houses in person. I've never even been to them. Like, I don't care. And they're just assets to me. I don't ask to go and look at my mutual funds and see the certificates of the mutual funds in the investment banks. I think that's the biggest. They get a 10% cut. 8% with a property once you have 10 or more, 8%, but it's 10% at first, and it's still worth it. These numbers are all assuming after you pay the 10% cut to the property manager, but that's what makes it passive income. You work with a property management team that knows what they're doing and that you can trust, and that's one of the reasons that I work with Mike Wolf, right? No, I know about the lease option stuff. I just didn't think of the, oh yeah, man, it's good stuff. It's really, really powerful. The way I look at it is like, this is the way to build wealth. I just don't understand how people don't see it. And like, I've been on TikTok. Who here, I know Professor's been watching, we've connected on TikTok, but who else here is here because you follow me on YouTube most of the time? Who here, give me a 1 if you follow me on YouTube most of the time. Give me a 2 if you're just here for the first time, and give me a 3 if you're here from TikTok, just so I have an idea. Oh, Dre. I didn't know that was you. All right. Rock and roll, man. Nice. Okay. Cool. Haha, OG. Yeah, you are. I didn't know that was you, man. I've seen your name on YouTube. I didn't know that was you on TikTok, so that's cool. That's cool. That's putting that together for me. I've seen your comments on YouTube before, so that's cool. So yeah, guys. Any comments? Any questions? I'm gonna have to go here shortly, but hopefully this was helpful. I was gonna try to get an in-force illustration, do some stuff, but then because of the idiot on TikTok, I had to go through a whole appeal process, and it distracted me, and I didn't get a chance to do all that. But I still wanted to go live because I was in that spirit of just trying to do something. So I figured I'd come here on YouTube and follow the OG people that have been following me for a while. Yeah, send me a message, man. Anybody that has any questions, wants any help, just email chris@life180.com. I'm happy to help. And it's exciting. I love this stuff, man. I love teaching people the real estate game. I love teaching people how to combine the whole life with the real estate. I mean, you could see it's a no-brainer, right? So anyway, you got it. Have a good night, guys. I am stoked. How do you combine real estate with life insurance? Well, Plain Fort, Patel, you are going to have to watch a replay, because we just spent a whole hour going through that. And explaining exactly how to do that. So if that's something you're interested in, I would totally say watch a replay, because we went super deep into all that. Unfortunately, you're just kind of getting here right at the end while we're shutting the show down. So hopefully you guys found value in it. And if you did, please like this, get it out there. Make a comment in the actual video when it posts, because that's, the YouTube algorithm, all that stuff. I think people need to see this. So have a blessed, inspirational night. We'll talk soon. Later.